$6.50 per pound. That's where copper hit on January 29, 2026, an all-time record. And before you think this is just another commodity story, before you dismiss this as something that only affects mining companies and day traders, I need you to understand something. Qatar's sovereign wealth fund just bet $500 million on a single copper producer. Not a diversified mining portfolio, not a basket of commodities, one company, $500 million. And Robert Friedland, one of the most successful mining entrepreneurs on the planet, just said something that should make every person paying attention sit up straight. He said humanity must mine as much copper in the next 18 years as we mined in the last 10,000 years combined. Not decades, not centuries. 10,000 years of human civilization. And we need 6 new world-class copper mines coming online every single year until 2050 to make it happen. If you think that's just mining industry hype, if you think sovereign wealth funds throw around $500 million on a whim, stay with me. Because what I'm about to show you is why the smartest money on earth is positioning for a copper crisis that most people don't even know is coming. My name is Ryan, and I've spent the better part of a decade analyzing commodity markets and trying to figure out what the big institutional players see before the rest of us catch on. And copper is telling a story right now that's impossible to ignore. So if you want to understand where global capital is really flowing and why it matters to your portfolio, make sure to hit that subscribe button and give this video a thumbs up if it helps you see the bigger picture. Here's what's happening. We're standing at the intersection of 3 massive forces. The first is electrification. Every electric vehicle requires about 180 pounds of copper. Every wind turbine needs tons of it. Every solar installation is copper intensive. The second force is artificial intelligence and data centers. JP Morgan just projected that data center copper demand alone will surge from 110,000 tons in 2025 to 475,000 tons in 2026. That's a 432% increase in a single year. The third force is the one nobody wants to talk about: supply. New copper mines take an average of 23 years from discovery to production. 23 years. That's based on actual data from mines that came online between 2019 and 2022. And we're not building enough of them, not even close. Let me paint you a picture of what's actually happening right now in the copper market, because the numbers tell a story that most financial media is completely missing. Copper didn't just casually drift up to $6.50 per pound. It surged 10% in a single trading session. One day. That's the kind of move you see when markets suddenly realize there's a structural problem. Then it pulled back to $5.98 the next day. But here's what matters. That's still up 40.58% year over year from $4.25. This isn't noise. This is a market repricing reality, and the smart money saw this coming. In September 2025, Qatar Investment Authority acquired a 4% stake in Ivanhoe mines for $500 million. They joined existing shareholders, Zijin Mining, which owns 39.6%, and CITIC Metal. These aren't speculative investors throwing money at the flavor of the month. Qatar's sovereign wealth fund manages over $450 billion in assets. They don't make $500 million bets on companies unless they've done exhaustive due diligence and see something the market hasn't fully priced in yet. Now, here's where most people make a mistake. They hear copper prices are up, they see a big investment, and they think, okay, prices go up, mining companies make more money, stock prices follow. Simple supply and demand. That's the trap right there. Because what's happening in copper isn't a normal supply and demand cycle. This is a structural supply crisis colliding with exponentially growing demand. And the gap between those two things is about to get catastrophic. Let me show you the demand side first. S&P Global projects. Global copper demand will rise from 28 million tons in 2025 to 42 million tons by 2040. That's a 50% increase in 15 years. But here's what nobody's talking about. S&P Global also projects a 10 million ton copper shortfall by 2035 to 2040 without meaningful supply expansion. 10 million tons. That's not a rounding error. That's roughly equivalent to the entire annual copper production of Chile, the world's largest producer. And it gets worse. The International Energy Forum published a study confirming that 6 new world-class copper mines must come online every single year through 2050 to meet net zero scenario requirements. 6 mines, every year, for 26 years. That's 156 world-class copper mines that need to be discovered, financed, permitted, built, and brought into production. And right now, we're nowhere close to that pace. But here's the thing that took me the longest to understand. It's not just that we need more copper. It's that copper is getting harder to find and harder to extract. BHP, one of the world's largest mining companies, published data showing that average copper ore grades have declined 40% since 1991. That means miners have to move and process 2.5 times more rock to get the same amount of copper they were getting 30 years ago. The easy copper has been found. What's left requires massive capital investment, cutting-edge technology, and longer development timelines. BHP estimates that the copper sector will need $2.1 trillion in investment by 2050. 2.1 trillion, with a T. That's more than the GDP of Canada, and that's just to meet projected demand. It doesn't account for any supply disruptions, political instability in major producing countries, or environmental challenges that could slow production. Now we get to the part that actually matters. Everything I just told you is context. But the question you should be asking is, where is this actually playing out right now? Which companies are positioned to benefit? And more importantly, what does the market really think versus what the fundamentals suggest? Let's start with Ivanhoe Mines, the company Qatar just invested $500 million into. Ivanhoe operates the Kamoa-Kakula copper complex in the Democratic Republic of Congo. And this isn't just another copper mine. Kamoa-Kakula is now the world's third largest copper complex and the highest grade major copper operation on the planet. In 2025, Ivanhoe produced 388,838 tons of copper, meeting their full-year guidance. Their 2026 guidance is set at 380,000 to 420,000 tons. But here's what's remarkable. Their Phase 3 concentrator is currently running 30% above design capacity. 30%. That's not normal. That suggests the ore body is even better than they expected. The story of Kamoa-Kakula is worth understanding because it shows both the opportunity and the challenge in copper development. The deposit was discovered in 2008. It reached production in 2021. That's a 13-year timeline from discovery to first copper. And that's fast by modern mining standards. Some reports have incorrectly claimed it took 30 years to build. That's false. The 30-year figure refers to the mining license term, not the development timeline. But even 13 years is a long time. Long enough that if someone discovered a world-class deposit today, it wouldn't produce meaningful copper until the late 2030s. Think about that. The copper we need in 2030 is coming from mines that should have been discovered 5 years ago. Now let's look at the established producers. Freeport-McMoRan is the elephant in the room. Their shares hit an all-time high of $60.35 on January 14, 2026. Currently, they're trading around $65. Analysts are projecting EBITDA of $12 billion in 2026 and $15.5 billion in 2027 to 2028. That's a company printing cash at these copper prices. Southern Copper reached an all-time high of $181.42 on January 14, 2026, up from a 52-week low of $72.86. That's a 149% move from bottom to top. But here's where it gets interesting. Ivanhoe Mines shares are trading at $17.72 Canadian, up 179% over 5 years. Raymond James just raised their price target to $22 Canadian from $19 in January 2026. That's a 24% upside from current levels. So you've got established producers trading at all-time highs, and you've got a rapidly growing producer with massive sovereign backing still trading below analyst targets. That disconnect tells you something about how the market is thinking about growth versus stability. If you've made it this far, you're already ahead of 90% of people who click on commodity videos. But don't stop now, because the next part is where this gets really complex and really interesting. Because the copper market right now is sending mixed signals, and understanding why those signals are mixed is the key to understanding what happens next. On one hand, you've got copper hitting record prices. You've got sovereign wealth funds making massive bets. You've got analysts projecting massive cash flows for producers. But on the other hand, combined copper inventories in Shanghai, London, and New York have risen above 900,000 tons. China's CMOC Group just announced plans to increase copper output by 11% in 2026. And here's the kicker. StoneX analysts are reporting that Western traders are bullish, while Shanghai Futures Exchange is showing net short positions at their widest since 2021. Western money is betting copper goes up. Chinese money is betting it goes down or stays flat. So what's going on? Why is the same commodity telling two different stories depending on who you ask and where they're located? This is where psychology starts to matter more than fundamentals. Because markets don't move on fundamentals alone, they move on perception of fundamentals. And right now, there are two competing narratives fighting for dominance. The bull case says electrification is real, artificial intelligence infrastructure is real, supply constraints are real, and we're in the early innings of a multi-decade structural shortage. The bear case says China's economy is slowing, electric vehicle adoption is plateauing, and current prices are already pricing in future demand that may not materialize as quickly as bulls expect. Both sides have data, both sides have logic, but only one will be right. And here's the thing that most retail investors miss. The big institutional players aren't trying to predict which narrative wins, they're positioning for both. Qatar didn't invest $500 million in Ivanhoe because they think copper is going to the moon tomorrow. They invested because in a world where copper demand grows significantly, Ivanhoe's low-cost, high-grade production makes them one of the best-positioned producers on Earth. And in a world where copper demand disappoints, Ivanhoe's cost structure still allows them to generate cash flow profitably. That's not speculation, that's strategic positioning. But there's another piece of information that should give everyone pause. Jefferies published research showing that major copper mining companies are internally pricing copper at $5.49 per pound for their long-term planning. That's well below the $6.50 peak we just saw. These are the companies actually mining the copper, the ones with the most intimate knowledge of supply, demand, costs, and market dynamics. And they're being conservative in their internal models. That suggests they think current prices may be overextended. Or at the very least, they're not comfortable betting their capital allocation decisions on $6 copper being the new normal. Now let me tie all of this together, because when you see how these pieces connect, everything changes. The real magic happens in your brain when you stop thinking about copper as a commodity and start thinking about it as the bottleneck in the entire energy transition story. Because that's what it is. You can build all the electric vehicles you want. You can install all the solar panels and wind turbines you can finance. But if you don't have copper, none of it works. Copper is the material that turns energy policy into physical reality. And here's the psychological trap that most investors fall into. They hear energy transition, they think about Tesla and solar companies and battery manufacturers. Those are the sexy stories. Those are the companies with charismatic CEOs and big visions. But copper miners are boring. They're in developing countries dealing with permitting issues and labor negotiations and ore grade challenges. They don't have the narrative appeal, but they have something better. They have the thing everyone else needs, and they're the only ones who can produce it. That's the shift the Qatar Investment Authority understands. That's the shift that Zijin Mining and CITIC Metal understand. They're not betting on copper as a trade, they're betting on copper as infrastructure, as the foundation of everything else that has to happen for the next 50 years of economic development to occur. And when you frame it that way, $500 million starts to look less like a gamble and more like buying a toll booth on the only bridge to the future. Almost there. But before I wrap up, I need to show you how all of this works together and why it matters beyond just mining stocks and commodity prices. Because the real story here isn't about copper. It's about resource scarcity in an age of exponential demand growth. And copper is just the most visible example right now of a pattern that's going to repeat across multiple critical materials over the next decade. Think about it this way. For most of human history, resource constraints were solved by finding new sources. Run out of copper in one mountain? Find another mountain. Run out of easy oil? Develop better extraction technology. The solution was always more exploration and better technology. But we're hitting a different kind of constraint now. It's not that copper doesn't exist. It's that the copper that's easy to extract is gone. What remains is deeper, lower grade, and located in places that are either geographically challenging or politically unstable, or both. The Democratic Republic of Congo, where Ivanhoe operates Kamoa-Kakula, has some of the richest copper deposits on Earth. It also has a history of political instability, corruption, and infrastructure challenges. Mining in the DRC isn't like mining in Canada or Australia. It requires a different level of operational sophistication, local relationships, and risk management. That's part of why Ivanhoe's success is so significant. They've proven you can operate a world-class mining operation in a challenging jurisdiction if you do it right. But it also shows you why 6 new world-class mines per year through 2050 is such an ambitious target. Because most of the remaining high-grade copper is in places that aren't easy. And this is where the timeline problem becomes critical. Even if we discovered 6 perfect copper deposits tomorrow, they wouldn't produce copper until the mid to late 2040s. The mines we need for 2030 should have been discovered 10 years ago. The mines we need for 2035 need to be discovered in the next 2 to 3 years. We're not just behind. We're structurally behind in a way that can't be fixed quickly even with unlimited capital. That's why prices spiked 10% in a single day. Markets are starting to price in the realization that this isn't a problem that solves itself. Higher prices usually bring more supply. That's economics 101. But when it takes 23 years to bring new supply online, higher prices today don't help you in 2027 or 2028. They help you in 2050. Maybe. If the projects don't get delayed by permitting issues or capital cost overruns or political changes. So what does all of this mean for you? If you're an investor, it means copper exposure isn't a short-term trade. It's a long-term structural thesis. Companies like Freeport-McMoRan and Southern Copper offer exposure to copper at scale with established operations. Ivanhoe offers higher growth potential with higher risk given their geographic concentration. But the broader point is that copper isn't going away as an investment theme. This is a decade-plus story. If you're not an investor, if you're just someone trying to understand the world, this matters because copper prices flow through to everything. Higher copper prices mean higher costs for electric vehicles, for home construction, for electronics, for infrastructure projects. The energy transition everyone talks about as inevitable, it has a price tag. And a big part of that price tag is spelled COPPER. And here's the hard truth that might sting a little. The Western world spent the last 30 years outsourcing manufacturing and mining to other countries. We optimized for clean air in our cities and cheap consumer goods. That worked great when resources were abundant and geopolitically stable countries controlled supply. But now we're in a world where the critical materials for our energy future are concentrated in places like the Democratic Republic of Congo, Chile, Peru, and China. We don't control the supply chain, and rebuilding domestic mining capacity takes decades even if we wanted to start today. That's the strategic vulnerability that sovereign wealth funds are exploiting. Qatar isn't investing in Ivanhoe because they love mining. They're investing because copper is leverage. Whoever controls copper supply has influence over everyone who needs it, and everyone is going to need it. That's not a commodity play. That's a geopolitical play. Your future self, the one living in 2035 or 2040, is going to look back at this moment and either thank you for understanding what was obvious or wonder how you missed it. Because the signals are all there. Record prices. Massive institutional investment. Supply deficits projected by every credible research firm. 23-year development timelines. 6 mines per year needed for 26 straight years. This isn't subtle. This is a flashing red light that says the world is about to run short of something it desperately needs. And just like that boulder you imagined at the beginning, the one you thought you'd be pushing uphill forever, you're no longer pushing. You're watching sovereign wealth funds and mining giants and industrial consumers all pushing in the same direction. Toward copper, toward securing supply, toward positioning for a future where the bottleneck isn't technology or capital or ambition. It's the metal that makes it all work. So here's my question for you. What's the next commodity or resource shortage that nobody's talking about yet, but everyone will be talking about in 5 years? Lithium? Nickel? Rare earth elements? What's the next copper? Drop it in the comments. Tell me what you think the next critical bottleneck will be. Because if this video taught you anything, it should be that the smart money doesn't wait until the problem is obvious. They position early. And the earlier you see it, the better your position when everyone else finally catches on.